Well, if we've learned anything this year, it's don't fight the Fed. We're going to dive into the details on that. My name is Brian Cannon, and welcome to Markets in 5. All right, I've got two charts I'm going to go through today. First one looks familiar. I've cleaned it up a little bit and changed a little bit. So I guess just to illustrate a couple of points I wanted to make. But essentially, if we look at the S&P prior to this year, it was very much a kind of a nice uptrending situation. And, so if you look at the RSI up here, it spent most of its time above that 50 mark, so between the 50 and 70 range. That again kind of shows you that it's a clean, healthy, trending market doing the right thing, right? When the tide shifted, you can see that everything kind of fell apart. So this year, the S&P has spent the majority of its time below RSI 50, and as a result, it's just been a choppy, ugly, downtrending market. And the times that RSI did pop above 50 and then pull back down, you can see that the follow-up, the red arrows, illustrate the violent downside moves and risks that comes from kind of the RSI rolling back over. So, it's been kind of a ferocious market this year. But again, if you kind of look at this and realize, which type of market do you want to be involved in? You want to be involved in one that's trending up with the RSI positive, or you want to be in one that's you're having to fight tooth and nail, to kind of survive. So when the Fed makes their announcement, essentially that tells you that they're stripping liquidity out of the market. They're pulling, they're trying to reduce growth. They're trying to reduce demand. There's more demand right there now than there is supplies, which leads to inflation. So they're trying to squash growth. So when I say don't fight the Fed, it just makes the environment for picking stocks a lot harder. So, so we've got our strategy where we want to essentially stick with the ones that are trending the right direction and avoid the ones that are trending the wrong direction. And sometimes those trends last very, very shortly, but essentially, it doesn't pay to keep a trade on for a long time. Buy and hold in this type of market is absolutely not good, in my opinion. I think you've got to be a lot more active in what you're in and for how long you hold it and when you take profits or cut losses. But essentially, when the market is doing this, it's being confirmed with the MACD down here. So where are we now? Again, we've got RSI that after the Fed chair yesterday, RSI dropped back down below 50. So to me, that's a warning sign. When you spend any time down here below 50, it's usually not good. And then you've got the MACD down here that, again, it's still positive, but looks like it might be rolling over. So we haven't gotten that quote-unquote death cross yet, but looks like it might be coming. So, and then you've got the price channel here. Looks like it's kind of dropping down a little bit lower. So I would say in the near term, you should have caution in what you hold, the amount of cash you've got, and you just got to be a little bit careful. And will the tide change today, tomorrow, the next day? Who knows? Probably. But right now, it looks like the near term has a little bit more risk to it than reward. So this next chart of the dollar, I believe, confirms my thesis on the S&P 500. So where the S&P 500 is rolling over and breaking down below 50, you've got the dollar that's breaking up and breaking above 50. So, right this year, the dollar and the S&P 500 have been very inversely correlated. So when the market's up, the dollar's down. When the dollar's up, the market's down. And so we've had this kind of stretch of the dollar kind of dropping until the Fed chair spoke yesterday, and now we've got the dollar's breaking out a little bit here above the mid-channel trend line. You've got it breaking positive above the 50 range, and then you've got looks like it's starting to lip up here with the MACD. Again, MACD is always a kind of a trailing indicator. So I would say based on the dollar starting to fall apart, the dollar starting to rise and the S&P starting to drop, pretty good chance that the near term is quite murky, and caution is definitely warranted. So in summary, you can see that, I believe we've got a little bit more downside risk than upside reward at this point, but the tides can change quickly. But with the dollar rising and the Fed tightening, it's generally not a good blend for stocks. So until we get any really good positive news that really changes the environment, I think it will pay dividends to be cautious in this point. So, but if you have any questions, give me a shout, and I'll see you on the next Markets in 5.